Hello everyone, good day to all. This is Kumar back in this channel. Today I'm going to talk about really the next wave of digital transformation in the banking industry. Digital is no longer a buzzword. Organizations are at the epicenter of a rapid change. While there is a rush to reach new frontiers, staying relevant is very important. This needs transformation of people, processes, customer interactions, and product and service development. Digital is that lever that helps think differently around these organizational elements, breaking organizational silos in achieving an overall transformation of the mindset. This is what I call and define as the art of digital. While many sectors, retail, financial services, including insurance, manufacturing, automation, many such sectors have embraced digital to a larger extent. One of the sectors in the financial service industry is the banking industry, which was one of the early adopters of digital banking. Today, I'm going to be talking about what is going to be the next wave of transformation in the banking industry. The introduction of new technologies has facilitated new consumer and customer behaviors. These new behaviors have facilitated the adoption of emerging digital technologies. The resulting virtuous cycle has ushered a period of rapid change which has profoundly transformed one industry after another. Industry incumbents have had to face a new reality where vertical integration, a fancy word for owning the entire value chain, has turned into a liability. Indeed, the virtuous cycle has allowed new competitors to deliver value at one point of the value chain without owning the entire value chain. Take the media and entertainment industry as an example. It used to be that content was king and pipes were dumb. Based on these heuristics, Hollywood studios ruled over an entire value chain and were comfortable living in a world where the only thing they needed to do was to deliver their content to movie theaters. This is no longer true. Even though original content still rules, pipes are not dumb anymore. Pipes are actually smart and that are built on top of platform strategies. Content is important, but so is how you create content, how you deliver it, with what and to whom, how you measure, how it is delivered, plus the balkanization of communities of users make it eminently more difficult for a vertically integrated entertainment business to remain at the top of the food chain without any profound changes. Witness the rise of players like Netflix, Amazon, with their different value propositions around entertainment content going forward. The financial service industry in general and the banking industry in particular are now faced with the same tectonic changes other industries have faced in the past. For banks, this is an even more perilous exercise as most of them have never faced a breakdown of their value chain in the past and have enjoyed near monopoly in their geographies, thanks to accommodating regulatory frameworks as well. Typically, one can define a bank's business which could be compartmentalized into four primary layers. These four primary layers are infrastructure, which comprises of IT hardware, mainframes, cloud hosted, and software, core banking systems, CRM, client reporting, transaction payment processing systems, analytics, products comprised of three parts, which are accounts, lending, and the rest: payments, savings, investments, brokerage, and advisory. The third layer, interface, comprising of branches, web applications, mobile applications, customer service contact centers. And the fourth layer is the client ecosystems, comprising of retail, SME, and enterprise areas. Yesterday's bank really owned each layer as described above. Clients dutifully visited their branches or relationship managers to consume products created by their bank, which were delivered by the infrastructure owned by the same bank itself. To the extent that banks faced competition, it was from another competing bank which also owned its entire vertical stack end to end, which was operating in the same geographical region. Today's bank is under threat at each layer of its stack instead, which makes for a much more complex competitive landscape. Clients spend more time somewhere else than with a bank. We all know the relative decline of branches. Not only are retail consumers not visiting their branches as much as they used to, but they also increasingly spending time in completely different ecosystems than in the past. Communities where a local bank relationship manager has little leverage, if any. These ecosystems are called Facebook, Google, Amazon, WhatsApp, Snapchat, Instagram, Pinterest, so on and so forth. Even though such change is not as pronounced with small medium enterprises and enterprise clients, there is also change happening with these segments as well. Clients are really used to a different customer experience based on the services they are getting from these digital communities, thereby making bank web application and mobile application always play catch up. In other words, clients are moving, banks and bank customer interfaces are under real threat. Products are under real threat as well. Although we have to nuance this statement and look at lending separate from the rest. Let's look at the rest first. Accounts are being loosened from the tight grip of the banks. PSD2 in Europe happened. The Open Bank initiative in the UK will take care of that as well, allowing under consent third-party access to accounts data and metadata. Payments is experiencing the highest level of competition given it has the lowest barrier to entry, either from fintech startups, endogenous to the industry, new entrants exogenous to the industry like Amazon, Apple, Google, Facebook, or grown-up startups, PayPal. Brokerage and investments are prone to the same opening to multi-competition. This leaves us with lending, which I believe should be analyzed completely differently than the rest, because no one will ever be able to come up with a zero marginal cost lending product. Indeed, the cost of borrowing is comprised of the bank's cost of borrowing and the margin to compensate for risk and provide adequate profits. That cost will never scale to zero or near zero. This, in my view, is the main reason why lending will never experience an Uber movement where banks will be completely disintermediated. Further, think of the unintended negative consequences of a massively large lender, for example, whereas the main cost of the rest is that of delivery and marginal cost of delivery can and should be driven down to near zero. Infrastructure is where there has been to date the least disruption and competition, notably around core banking systems and CRM. Even though blockchain technology holds the promise of much change in asset servicing. To date, the overwhelming number of competitors attacking the above layers have not been extremely successful, while there has been medium level success. Fintech startups focused on investments, robo advisory, brokerage, lending have not reached escape velocity and acquired meaningful market share to the detriment of banks. Some industry pundits believe it is because banks have much more defensible business models like regulation, licenses, so on and so forth. Indeed, banks have focused on revenue optimization strategies, pricing, cross selling, upselling, margins, or cost reduction strategies, layoffs, better hardware, better software, by applying concepts of digital banking, API banking, mobile banking, cognitive banking, artificial intelligence, analytics on existing business models. To the exception of a few banks who have started working on a platform strategy which forces them to address the competition they will face at each of the four layers as described above. All other banks potentially are still in a vertical integration paradigm. This has to really change. The market will automatically force that change. Some banks will adopt, other competitors will have to rise to the challenge. I view all of these bank moves as incremental evolutionary steps, good enough to compete another day, not good enough to reinvent banking itself drastically. A digital bank, and there are many startup digital banks globally, for example, are still vertically integrated, even though they hold the promise of being the so called better bank. Incumbents will have to choose how they want to compete going forward. Below, I share some of the potential options available. Option 1, the better vertically integrated bank. Essentially, more of the same, that is a bank that still owns the entire stack, will compete against a multitude of competitors, but will do so better armed marginally, digitally so, less siloed, better hardware, better software, less employees. Although I believe some will be successful at this strategy, I'm afraid it will be a very risky one. No network effects to speak of, no ability to drive to meaningful zero marginal cost of delivery for all products such a bank would offer. Option 2, the platform and vertically integrated bank. As described above, as stated above, it's almost similar, but with some type of platform strategy that is engaged, that will allow a bank to partner with third parties and share the value created by delivering better products and services to consumers. Probably a bit of less risky than the above option of a vertically integrated bank. Still a difficult proposition in a world where modularity will be more and more important. Option 3, the partially vertically integrated bank. Whether traditional or platform driven, this bank will drop a few non-core activities, not enough to not be vertically integrated, but enough to reach another level of rationalization. I at least expect or believe Tier 2 and Tier 3 banks with limited resources to be the best candidates to follow this model of partially vertically integrated bank. Some, some of these candidates of partially vertically integrated banks make a hard turn to this model, very interesting as a platform strategy. Option 4, the interface bank. No more vertical integration for this type of bank. To date, we have only seen interface examples. Simple is but one of the examples. The interface specialists have suffered from a disconnect with the ecosystems where users gravitate and have not been successful to date. The key to success will lie on how an interface bank partner with these digital ecosystems. My gut feeling tells me artificial intelligence powered virtual assistants may have a shot at being very successful interface banks. Strong potential for network effect and driving to zero marginal cost of delivery. Option 5, the product bank. By far the most intriguing layer strategy, product banks focused on innovating only on one particular product or a family of products. When was the last time the financial services industry came up with an innovative lending product tailored to someone's cash flow patterns? A product bank would partner with interface providers and or any of the ecosystems of users, for example. Not network effect to be expected for lending products. Definitely for other products. But the benefits of innovation and differentiation can be powerful. I would even expand the horizon of what a product could be by including data being the new hot asset class, and data management as well as identity management being crucial in our digital age. Why not see the emergence of these new data banks? Option 6, the infrastructure bank. Potentially 3 separate models emerge out of these infrastructure banks. Let me list out these 3 potential models of infrastructure banks. Model 1, the generalists, which is a hot market today, banking as a service, or what we call as the BaaS model, that will deliver services to product banks, interface banks, startups, partially vertically integrated banks, fintech startups, enterprises. Banking as a service is the most promising bank model of the future, as the focus is on the provisioning of products as a service or of any services. We are not dealing with lending here. We are dealing with delivering the building blocks to enable lending. The same applies to all other activities. As such, there is a very high probability for this model to drive to near zero marginal cost of delivery. In this context, we can apply the Uber label to the generalist banking as a service model. Model 2, differentiated specialist banking as a service model. This model is particularly relevant for high value added services such as advanced data analytics, underwriting analytics, risk analytics. Remember one of the points I made at the beginning of this post or this recording. There are no dumb pipes anymore, only smart pipes. Today, banks are arming themselves with the service startups specialized in data analytics, which can offer CRM, fraud detection, so on and so forth. But it is conceivable that specialization will be so important going forward, and the pipes so strategic that a bank will provide this as a service going forward instead of a non-licensed startup. Model 3 is a commoditized specialist banking as a service. Here I really expect some infrastructure services to become commoditized faster than others. Think hardware fine-tuned for banking use cases or core banking systems. Think about an AWS offering for banking. Much like there are core processors for specific activities, video, gaming, artificial intelligence, there may very well be core infrastructure provider for these banks. If all of the above model vision comes to fruition, and we do see a segmentation of banking, we could expect the regulatory and licensing landscape to change. In other words, we will see a new regulatory approach where different types of banking licenses will be issued based on the business model and its implicit and explicit risk to the market and to clients or consumers. Just to state one example, an interface bank as an artificial intelligence powered virtual assistant may have to meet certain licensing requirements around providing financial advice to its clients, but may not need to comply with really lending requirements. To be much more clear and to provide more clarity, some fintech startups competing or providing services at each layer level may not require the same type of banking license as the banks that will operate at each layer levels. Further, competition at each layer level forces one to think platform strategy, which result in either developing and implementing one's own platform strategy or becoming one of the building blocks of someone else's platform strategy. There is no escaping platform strategies going forward. Additionally, layer specialization other than with lending can deliver very strong network effects enabled by near zero marginal costs of delivery. This, I strongly believe, will potentially be a revolutionary paradigm for banking. Finally, the bank that will successfully partner and integrate with ecosystem of users, regardless of the approach taken, will stand a higher chance of success than trying to create their own new communities or continue with existing ones. Like it or not, social networks are here to stay and will take on a greater importance in our lives going forward. Trying to craft a roadmap for the above vision is really tricky. We are in early days of different platform strategies or marketplace strategies for banks, and much remains to be done. No one has declared a banking as a service, for example. I believe that we could see increased activity along these vectors in the next 2 to 5 years. The actions of players like Facebook, Google, Amazon, Apple, Alibaba, Snapchat, Instagram, WhatsApp, so on and so forth will make that absolutely inevitable. Incumbents may also naturally gravitate towards a few of the options stated above, either as a result of further divestitures, acquisitions or mergers, leaving space for new entrants, large technology companies or fintech startups. In other words, the industry is large enough to see various participants succeed and avoid a bank lose. New entrants win scenario or vice versa. Last parting thoughts that I would like to share. I strongly believe the above also applies to the insurance industry as well with the appropriate tweaks. Thank you very much for listening into this talk about the next wave of transformation in the banking industry. Please share your views and thoughts on ongoing transformations in the banking industry and the future of digital-only banks and banking as a service. Please share industry experiences, example models. I would like to hear from industry experts as well. Thank you very much for listening in. Thank you.